This is Power Trading Radio Live. Power Trading Radio Live, fueled by Online Trading Academy. For more information on the show, visit us online at powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome to Power Trading Radio. Merlin Rothfeld with you for your Wednesday edition hump day. Interesting one out there today. A little bit of an about face. Things look nice and positive as we heard some of the, relief from China with regards to the virus issue, and all of a sudden markets started to sell off quite a little bit. When we look at the daily charts over here, things get fairly ugly, but we'll start with the real ugly stuff first. Crude oil actually doing what we talked, 2 weeks ago? I think 2 weeks ago we talked about it pulling back into an area of demand that was kind of weak. Talking about people maybe making potential trades there. Said, it's not the best demand zone. There's one much further lower, and we were 3 cents away from the top of that demand zone, in my opinion, today on crude oil. We'll start there. Crude oil. Actually, no, hold on. We're not starting there. Don't even go to the charts, CJ. I forgot. Yesterday we were talking about having an all Merlin show, which apparently nobody wanted the Merlin show because not one of you sent in questions. Actually, 2 of you sent in questions, but I was expecting a lava flow of questions for the show today. Unfortunately, you guys didn't send them on in, so I went out and I found myself a guest. I figured you guys probably did not want to hear me blab the whole show because otherwise you would have sent in questions. So no blabbing. I will try to get our guest on the program. Now, that said, our guest is awesome. He's like one of my go-to guys when I think about what's going on in the bond market world, the fixed income world. We're hearing a lot of interesting things about the corporate debt market right now. A lot of people really freaking out about the way that corporate debt is going and people's increased appetite for risk and buying junk, as a lot of these corporate bonds are now BBB, which is in that junk category. So Bill Addiss will be our guest. You might know him from the Mastermind Clubhouse sessions. He'll be on the program today talking about instruments, new maturities, different products that are coming out, as well as answering whatever questions you guys have with regards to bonds and I guess we'll just say debt securities. So if you have questions, feel free to send those on in at powertradingradio.com. You can click the little button there that says Power Blast, or join us on our 2 YouTube channels, which is Online Trading Academy's YouTube channel, as well as Power Trading Radio's YouTube channel. While you're there, hit that little thumbs up button, give us a little love, and hopefully we'll have a great show today. All right, now you can bring up those charts, TJ. We're going to start with the worst and work our way up to first. Very poetic the way I did that one. Here's your crude oil chart. Now, those 2 levels we were talking about just a minute ago, we were looking at this point right where TJ has his horizontal line. That was what? Go give me the date there. The 13th of January. That was an area where I thought, there is demand there, but it's not really strong. I mentioned that for those of you who know the Online Trading Academy odds enhancers, you could probably run those through the calculator and realize that this isn't the best spot. Now, there was one that's better, still not perfect by any stretch of the imagination, but we focus on this level way down here, right around $56. It's actually a hair lower than that, right around $55.96 is the beginning of that area. And today we came down to a dead low on crude oil of $56.03. So just barely touching that, not even touching. It was 6 cents away from that demand zone. So missed it by a couple ticks on my end. Either way, we had a really ugly day out there for crude oil. Right now sitting at $56.10. That's a slide of nearly 4%, 3.87% slide today on crude oil. And obviously over the past couple of weeks, just a significant decline there. But we are coming into an area of demand. Now that dropped at about $2.26 per barrel, making it by far your worst performer. Next on our list, number 6, Bitcoin cryptocurrencies. Might have a little bit to talk about with this today. I think you'll hear a lot more on this topic heating up as central banks are now starting to think more about digital currencies. Bitcoin was not a benefactor today. Down 1%, an $87 slide to $8,637 on the session. You can see really for most of the last 13, 14 hours, just flatline, not a lot going on. But that made it your number 6 performer on the day. All right, number 5. Let's see what we've got cooking on the click charts. We're going to go to the Russell 2000, which happy to say I'm still short. And in the after-hour session, it's selling off pretty good right now as well. You are at 1681 for the RTY futures contracts. That is about 3 points lower than where we closed at, which would have been down 0.09%. So all in all, it started off decent and then just got a little bit weaker on the session. We were looking pretty good when we opened, but again, that weakness persisted and we closed near those session lows. So not a great showing for the Russell 2000, which came in 5th place. Treasury yields also in vogue. We had the ZN futures contract, which of course is that U.S. 10-year Treasury note futures, unchanged on the day. You really had nothing change there. You can see that the candle there is a really small spinning top, little doji formation, so not a lot to work with on the ZN. But all in all, there you go. That's all I got to say about that. All right, podium time it is. Now we're going to the S&P S&P 500, where's the SPY? SPY, there we go. S&P 500, daily chart still looking fantastic, although you had what very similar to what we saw with those treasury yields. You have this big indecision moment. We did hit an intraday all-time high, which I think jacked in a whole bunch of bulls, got them all excited, and lo and behold, we closed right near those session lows. We were still positive, 0.03% for the S&P 500, closing at 3,321. Right now, you are 4 points lower in your after-hours session. All right. Oh, look at the crowd. Hey, Harrison, I'm Merlin. That's who I would be. You know, who's Merlin? That's me. Yes, my parents gave me that name, so I didn't make it up to be some sort of internet celebrity. I was tortured through my childhood with the name of Merlin. But thanks for asking. All right, that was what was that, TJ? That was number 3, so we got to go to number 2. Bring up our gold over here. Gold on the day, showing it's slightly better than the S&P. We're only up 0.05% on gold to 1558. Technically, really not exciting, right? We've had this week of just sideways, nothing going. Like Brendan says, my account was perfectly flat today. Not a lot really happening. You know, what's interesting about that, Brendan, is there was some that was actually very strong. At one point, your account was probably doing rather well, and then gave it all back, and we ended up unchanged. So for long-term investors, you look at those numbers and go, nothing happened. Actually, a lot happened. All right, here's your NASDAQ 100. On the day, you're looking at the NQ with a shooting star formation. This, to me, says we're going down. Why? Well, it's at the end of a major uptrend. It's the first time we've had a shooting star in quite some time on the NASDAQ 100 futures. While it is a green candle and finished the day up 0.14%, it is one of those things where we were really ripping much higher, and all of a sudden things start to sell off. So what I would... how I would trade this, which is what usually comes up, is people say, how would you trade that one? Look, I'm going to put a line right below the lows of the day. And the low of the day for this candle is, TJ, give me that one, 9,174.25. If we open up tomorrow and close below, or as soon as we close below that line, there's your shorting opportunity for the NASDAQ 100. Keep your eyes on that one. That was your best performer, up 0.14% for the composite. But all in all, not the best day out there. A lot of it looking fairly negative because of the way we finished on these markets near the tail end. So that, my friends, is your top 7 markets. Hopefully some of those put some green into your pockets, but it doesn't look like they did. They probably just kind of ended up flat on the day, unless you were short crude oil, which is your big mover out there. Okay, where to go for this one? I have a bunch of 3 questions that came in. 2 came in last night, and 1 came in this morning. Leonard sent this one in yesterday. He says, I'm an OTA student struggling with SIM, trying to get it to do what I want it to do. Now, I don't quite know how to answer this question, Leonard, and there's a reason for it. If you're struggling with SIM trying to get it to do what you want to do, is the question that you're struggling to use a platform, and that is where the struggle lies, is you just can't seem to get it to execute right or set up the way you want and get your layouts and all that type of stuff. Is that where the problem is? Or are you saying that you're trading in SIM and you're not getting the results that you want with regards to profit and loss gains and things like that? Those are 2 very, very different questions. I'd love it if you told me which one. I will probably answer both of those for right about now. If your issue is that you are not understanding a platform, could be any platform, could be Click, which is our platform, could be TradeStation, Thinkorswim, doesn't matter. There's always tutorials out there which will help you understand how to use it. My recommendation is that if you're not sure how to use a specific platform, forget the tutorial videos. They're a total pain. Find somebody who is using your platform who's good at it. I usually just, when I was on the trading floor, I just look over at my neighbor and be like, hey, how do you do this? And they go, 2 seconds, show me, got it, perfect, now I know. That would be step number 1. If you're part of the Online Trading Academy community and maybe the issue is with Click, there are tutorial videos, but when you're in the mastermind sessions, you're in the XLTs, ask questions on specific pieces if it's going to help you understand better how to facilitate the platform. Now, if the issue is that you're not getting the trading results that you want because you're in SIM, well, you have to start doing a lot of analysis, evaluate what you're doing right, what you're doing wrong, find out maybe what securities you're trading best. It's all about analysis. Quite often what happens is when we're in class, we do specific exercises which are generally on a smaller time frame. The reason for that is we're doing these trades in class trying to get results. So when people go home, they maybe want to do on a bigger time frame, but they still use those small little stop losses we use in class, and that may be impacting. So Leonard, if you want, give me more information on exactly what it is that you're struggling with. Be detailed and specific, and I might be able to give you some insights which can help you overcome those obstacles. But if it's platform, that's really easy to overcome. You just got to practice with it and get someone to show you how to do it. If it's on the trading side, That's a different one. That is a much different question, and that really revolves around what education that you've had. Have you taken Online Trading Academy's classes? Because then you have kind of a structured approach, which is rule-based. If you learn from somewhere else, who knows? I don't know what strategies or tactics you've been learning. So let me know what it is. Send it on in at powertradingradio.com. Click that button that says Power Blast, and I will get to those as soon as I can. All right. As I mentioned earlier, we're going to talk about interest rate products, bonds. We had an inverted yield curve last year. A lot of interesting things going on with negative yields around the world. It's been dropping significantly to the tune of about $4 trillion here recently, which is great. But we do have a lot of bond talk. We're going to have Bill Addiss on the program right after a quick break to talk about some of those interest rate products. If you have questions regarding bonds, yields, maturity, all that type of stuff, premium payments, you want to know about how the Fed works, send those questions in at powertradingradio.com by clicking that Power Blast button, or join the community over here on Power Trading Radio's YouTube channel, as well as Online Trading Academy's YouTube channel. And we'll be right back with Bill Addiss after a short break.
What if you knew the income strategies professional investors used? The strategies designed to generate active income from the financial markets. After all, no one's going to care more about your money than you.
I learned that I can be in control of my 401k.
I used to work for money, now I have my money working for me.
With the right training and guidance, you can learn the skills to become a more confident investor and make your money work harder for you. Want to find out what's possible for you? You can, as long as you're willing to take the first step and call OTA today.
Call for your free tickets right now, and you'll also receive a free Professional Insiders kit loaded with lessons from some of our top instructors on topics like enhancing your retirement strategy, capital preservation, and income generation. The Professionals Insider Kit makes it so you can get started right now.
Call 888-304-8723 or visit us online at tradingacademy.com and schedule your free class today.
Click is something I wish I had when I started because it facilitates the learning process a lot quicker.
This is not about taking many trades, it's about taking the right trade.
It helps me save myself from myself. It's just a revolutionary educational tool. It propels you through the learning curve.
The biggest shock for me is the level of innovation that happens within the company, and it's continuing.
It's just perfect in this new century of trading.
Everyone's on the same side, and I think that's what I love about it more than anything else. Helping each other, supporting each other, all with the same objective. Again, wonderful.
There's no mountain high enough that the leaders in this organization won't climb for their students. They'll just never give up.
It can only help. It can only make one a better trader.
Gives you one of the most valuable things we all have, and that's time.
Welcome back to Power Trading Radio Live and your host, Merlin Rothfeld, with today's special guest.
Hello, everybody. Welcome back to Power Trading Radio. It is your Wednesday edition. Now, of course, next week we have some Fed announcements for the U.S. Normally we have Bill Addiss on the program for that, and who knows, we may actually get him on the program for that one as well. But I wanted to bring him on today because there was a couple questions or comments about headlines that came through in the newspaper talking about fear in the corporate debt market, how corporate debt is kind of falling out of vogue in Europe. We also have a lot of talk about negative yields with Jamie Dimon making some comments as well. So I thought, you know what, let's bring him on a little bit early to talk about some of these markets. We have Bill Addiss joining us today. Bill, how you doing?
I'm great, Glenn. How are you? And a belated Happy New Year.
Yeah, Happy New Year. Everything going okay? It feels weird when I don't get to talk to you that often, but I guess once a month is it's like we're like the Navy Army Reserves or something. I get with you once a month, 1 week in a month.
As schedules permit for both of us, but it's a pleasure to be here.
That's right. Well, you know what? I'll start with just kind of asking you what's going on in your world, because I know you live a very different life than I do. I'm usually here in studio or in Online Trading Academy in California working on content and building. I know that you travel around and do a lot of teaching for major institutions, some of which we can, I'm sure our viewers know very well. Is there a topic du jour, a hot topic amongst those institutions that maybe you want to share with us?
You kind of touched on it even in the introduction, is just the proliferation of, and I hate the word bubble, it's so overused with everything. But when you talk about the amount of debt, if you look back over the last 10 years and you say, okay, what's gone on? Year-end's a good time for retrospection. And the corporate market has just exploded. Looking at an article I just recently read that I think you forwarded to me, corporate bonds investment grade went from $700 billion to $3.2 trillion in the last 10 years. I mean, corporations that didn't even need the money were issuing bonds because interest rates were so low. Why not?
Sure. And I think that this is, when we look back, when the history books look back and write about this, when your grandkids are going through finance school and they're going, well, we remember back in 1999, we went negative yields. I think it's worthwhile mentioning why this is happening, right? So for the investors out there, for those of you especially during retirement, as you get near retirement, you're going to want to have fixed income or income streams coming into you so that you can preserve your capital. Of course, if you're in your 20s and 30s like TJ is, he's going to go very aggressive, be more equities. He's not worried about bonds so much. But as you get older, you kind of want those bonds in your portfolio to give you some stability and income stream payments. Now, when you're looking for yield, of course, treasuries are going to be the safest thing you can get, and you start to move up this spectrum of interest rate products or of bond products where you start to get riskier and riskier and riskier. You start to get towards the apex of this, which is getting very risky. Now you're looking at, historically, that was corporate bonds, and companies would issue this to raise capital, and they'd have to charge a high yield because people were worried about the risk. Now, because we have negative yields going on, we've got our treasuries and et cetera almost yielding you nothing, people are chasing yield. So what's happening is they're buying corporate bonds, throwing caution to the wind, and in essence what this is allowing corporations to do is say, you know what, I have so many people lining up to buy my triple B rated stuff, which normally I'd be paying like 9%, I'm going to charge 5% because I have such demand. I can lower that because people are chasing yield, don't want 2% from treasuries. I'm going to get my corporate stuff for 5%. And now all of a sudden we are taking on extreme risk for not much reward. And to me, this is spelling a recipe for disaster.
It really is, because as you said, the credit spreads on corporates have narrowed so much, meaning the yield premium the investor gets over treasuries. So you're taking more a yield commensurate with the risk that you're getting. So this what we call the compression of the credit spreads. I don't mind taking risk if I'm being compensated for it, but if the market isn't going to compensate me for that risk, you have to wonder why everyone's jumping aboard. And the answer is exactly as you said: is they're looking for any yield possible. Mm-hmm. If I can get 4% on a let's say triple B rated piece of paper, maybe that's worth taking the risk because it's better than zero or negative. That we're saying some.
Yeah, it's kind of scary when you look at the bond ratings. I was actually going to see if TJ could bring up the bond ratings chart just so I could see that one and maybe bring it up for the viewers if you can, TJ. I know we're looking at a bunch of different stuff over here. Yeah, that should do it. Just so you guys can get a perspective, we'll see if we can bring this one up. We're going out to a third-party site. So I want to make sure we have safe for work ads on this one before I show it to anybody. Of course, it seems to be taking forever. We'll find another one. Perfect.
While you're looking at slides, can I maybe preface it by talking about the triple B rated mark?
Please do. Yep. Yeah, go for it.
They talk about in the proliferation of all of these corporations issuing bonds. The biggest bulge of those are bonds that are triple B rated.
Right.
Now that's important because triple B is the last category of ratings before, if you get lower, you become a junk bond. Mm-hmm. And that creates some real problems. If we have any sort of an economic recession or downturn, recession, that's literally 50% of the corporate bond marketplace is made of these triple rated bonds. Kind of feels like something hanging over your head.
Yeah. Well, here's the list. Okay. Of course, when we talk about in our classes saying, hey, you should be invested in bonds. There's a huge spectrum out there, and it's not to say that everything needs to be investment grade or high grade, but you certainly want to be careful with what you're investing in. So, TJ, bring this up. We have AAA, which is prime. That's the top shelf. You're not going to get much by anything that's prime. But you see it kind of drifts down here, and all of a sudden, as Bill was mentioning, you got this triple B rating, which is lower to medium grade. And then below that, you get to the double Bs. It's non-investment grade, speculative, and it's basically junk. And this is the concern, because what's happening now is so many people are not paying attention to this. They're just chasing yield, and they're putting themselves in harm's way. So let's go to show you. Click. Here's the high yield. This is the high yield corporate bond fund ETF, just to give you guys a perspective of how much it has moved since December. Now in December, this HYG is the ticker symbol out there, if you can see that one. And I'll maybe zoom out a hair so you can zoom in here. In December, early December, we're about 86. Right now we're at 88. Now, I know that doesn't seem like a big percentage move, but remember, these shouldn't be moving very much. These are bond products. This is the underlier of the bonds. Shouldn't be this volatile. Now, what it's signaling is more money is pouring into this asset class, thus driving prices up, especially when we look back at 2019. It was just a phenomenal year for junk bonds. And again, this is obviously a big risk factor simply because if more people are taking on this risk, what will happen, and a lot of, you may have read this as well, that there's a lot of analysts who are saying that coming up here, the ability for these corporations to make those debt payments is starting to feel the pinch. And if that does happen, that means that these corporations could be headed towards a period not only where they get downgraded, which could very easily spike these things, or also default. What's our threat there, Bill?
Well, the risk here is a liquidity risk. And just to follow up even further, what you were saying is, if a company gets downgraded and it drops down into the junk category, realize most funds that own investment-grade bonds own investment-grade. They really and truly can't own junk. Like the fund you were just talking about, it's just the opposite. They only own junk. So if a bond like Ford comes from investment-grade down into this category, those portfolio managers who own Ford fiduciarily have to get that bond out of their portfolio. Even though they bought it as investment grade, it is now, given the dynamic nature of ratings, slipped into the junk category. So you've got this huge potential overhang of supply of all of today's investment grade paper that have to be liquidated as paper. And the universe of junk bond buyers traditionally has not been as big as the universe of investment grade.
Right, and it's funny because it's skewing that dynamic, and I think when we look at the amount of junk bonds, go back 20 years versus what there are today, it's significantly higher, and it's just about understanding risk reward. My concern for everybody out there is we have these historical investment models, which as we get older, hi Dad, by the way, you start to look for safety. You start to look for security and preservation of capital. If you guys take Strategic Investor, this is really what we're focusing on, is identifying where we are in the spectrum of our working life and saying, at what point do I want to now become more defensive and preserve this wealth bucket that I've grown through my 20s, 30s, and 40s. Now I want to make sure it's not exposed to too much risk. And the danger here is that as we move into these traditionally lower risk investments, bonds typically, there is now elevated risk in those assets. And to me, it really just speaks volumes to why we have to pay attention to what we're doing. Don't arbitrarily just buy HYG thinking you're going to get some high yield. There could be some problems there. And if some of those do go under or we see some defaults on there, then you very quickly could see this thing drop from 80 back down to in the 70s in no time at all. It's a risk factor that you have to take into consideration. And our current environment, thank you Federal Reserves around the world, have helped facilitate that. Let's do this. Let's take a quick break. When we come back, I want to go into some other topics here. We spent a bunch of time on that one. Maybe we'll talk about, CBDs are a really hot topic, but I'm going to go into something a little bit different. I'm going to go into CBDCs, which are central bank digital currencies. I know Bill's not a big crypto guy, but we'll see what the prospects for digital currencies might be in his world. We also have some more bond questions coming through, so if you guys have some more for us, let us know what they are. Send them on in at powertradingradio.com. Click the button that says Power Blast, or if you're on your YouTube channels, say hello to everybody out there. We've got Harrison, we've got Brendan, I saw Austin, we've got a newbie out there today. Hello, Austin. Glad to have you live for our show. Gonna give you a little shout out. We got a couple others. I think Terry and there were a couple others that are the first time on the show. So good to have you guys with us. And thank you, Stacy and Steve, as well. Yes, my parents were magical, by the way. They still are magical. I like to think that. All right, we're gonna take a quick break. Bill Addiss is our guest. If you have questions, send them on in, and we will be right back after a short break.
Learning this way is fine when the stakes are low. But when the stakes are high, you need to rely on skill, not just knowledge. At Online Trading Academy, you build your skill one step at a time. We teach our students to trade and invest with a strategy, not a hunch. You learn our methodology, then practice it. You get to make mistakes and ask questions, and watch instructors make live trades. Develop your skill the right way. Click here to get started with Online Trading Academy.
Meet Mac. As a trader, he liked the signals that came from technical analysis tools, but they didn't help him find the best trades consistently, so he searched for a new approach. Mac attended Online Trading Academy's free class and discovered their core strategy, a trading methodology that spots when big banks are likely buying and selling, so everyday investors can too. Mac carved out a path to trade and invest with confidence, and so can you.
You've been listening to Power Trading Radio, live, fueled by Online Trading Academy. To learn more, visit us online at powertradingradio.com.
Hello, everybody. Welcome back to Power Trading Radio. Merlin Rothman with you for your Wednesday afternoon edition. We have bond expert Bill Addiss joining us on the phone today. We're going over really just talking about high yield and corporate debt bond markets around the world, which has been an interesting development as we've seen global communities, not just Americans, but everybody chasing yield. Corporate bonds have been dropping their yields, and of course their ratings have been dropping as well. And many are pointing to that as this kind of secret bubble behind the scenes. That's not just the bond market itself, but a specific one, which could really be, because it's so huge, that corporate debt market. Let's see, Paul said this question. He said, would you say that a CD is safer than bonds, and are they similar in the risk? Bill, you got any comments on that one?
Yeah, great question. And two delineations that are important. Number one is, with a CD, you can use the word government insured.
Yep.
You know, you are getting a government insured, government-backed rate thanks to the FDIC. So for $250,000 per deposit or per institution, you're at the safest element of credit quality whatsoever. But the problem with a CD, though, is you have no liquidity.
Right.
You know, banks don't understand trading vehicles, so they sell you a CD. If you need to get out of that CD before its maturity, you're going to be hit with an interest rate penalty. Your actual rate of return will be less than zero.
Right. So let's be
for
fair.
Liquidity purposes,
it's not a liquidity question because you can get out. There's no question about liquidity. It's just you could be slammed for removing it, and they're growing your gains.
Good point. Good point. Liquidity with penalty. But from a safety point of view, but here again, that means you're going to be at the lowest yielding end of the spectrum.
Right.
CDs are not much higher yielding than treasuries, and on treasuries you do get a state and local tax exemption that you don't get on CDs. So looking at it that way, I'm not sure it's worth it. But you should shop your banks because CD rates vary greatly institution.
Greatly. And I'll give you a little, just an asterisk and a personal experience that I had recently. I'm always chasing yield, I guess you could say, but I always want to have my emergency fund and have cash liquid and readily available. I received an offer from, I know it sounds crazy, Discover Bank, because I have a Discover card, I know, don't hate. I have a Discover card, and they offered me 2.1% for a savings account. I couldn't believe it because the CDs that they offered there were 1.9% for a 12-month CD, but they offered me 2.1% plus if I opened it with $25,000 or more, they gave me an extra $250 for keeping that money there 3 months. So of course, what do you think I did? I moved $50,000 over there just because it's beating any savings account I could possibly find. Now we're seeing yields move up a little bit, so who knows, maybe I'll get another offer from another bank, but always search around. But to the question earlier, I think Bill is absolutely right. You're safer with the CD simply because you have that FDIC insurance, you're protected there. If it's any sort of corporate thing, I don't trust it. I certainly would spread my investments around, but that could be a dangerous one. Brendan says, Brendan sent in a few here. He says, how do you personally measure risk off flows from institutional money?
I have to question what he means by risk off flows on institutional money.
Yeah, it does leave a lot of. Brendan, I'll let you answer that one here. Because he's in chat, he's always answering those. Let me just go to another one.
Okay, good. If he's saying institutions going for the risk off trade, we could address that, but I don't want to interpret.
Right, yeah, we could go down a rabbit hole on our own. Let's see, what are your favorite fixed income instruments that are not bonds?
That's a great question because I'm not an annuity fan.
Yeah, neither am I.
Put my biases right up front, so I'm not going to go there. But here again, I am a bond guy. When you're talking income, certainly preferred stock has been a popular asset category. Because basically most preferreds in the U.S. are fixed dividend preferreds. The obligation to pay is the senior obligation. So the people who buy bonds are very much the people who buy preferreds. But the benefit of a preferred is perpetuity.
Right.
When you buy a bond, for better or worse, usually for better, you're getting your principal back when the bond matures. When you buy a preferred stock, you're going to get that income in perpetuity, until you sell the stock or whatever.
Right, yeah. All right.
And the yields on preferreds has been very attractive. You've got good liquidity. They trade on exchanges like an equity.
Yep.
You've got that fixed dividend. I have only good things to say about preferreds. And if you look, when Mr. Warren Buffett makes an investment in an institution, it's usually in the form of a preferred stock.
Right. I mean, and that said, obviously do your research because not all preferred stocks are great. It's the same thing as like picking a stock or a futures or options. There's always going to be good ones and bad ones out there, but there are some merits for them as far as a kind of fixed income. Now, I agree with Bill. I'm not an annuity fan at all. I believe that if you know what you're doing, you could completely build your own annuity type of product. And we talk about that in Strategic Investor, really showing you exactly how to do it step by step. And when you do that, you remove all of the fees associated with the insurance companies who are selling you those products. And in many cases, that could be 5 to 10%. Well, if you save yourself 5 or 10% on your investment over time, that obviously adds up to a lot of money. So that I would be much bigger fan, of course, when you're looking at the annuity products like that. They're using, typically, bonds. So, Brendan, when you talk about risk off, he said movements into bonds. So for Brendan, I think he's just saying risk on would be moving into stocks, risk off would be moving into bonds. It could also be utilities and metals. So when you see big institutions kind of moving into the bond markets, does it give you any signals of anything?
Well, and this is where, most people, there's an inverse relationship between stocks and bonds.
Right.
When one goes up, the other goes down. But as we're showing here, that's not necessarily the case as we're seeing here. Because, let's be honest, as we speak, we're getting record high prices on the equity market. Prices are going up. But as we're talking about all this demand for corporate bonds, the prices also, as you just saw on HYG, the prices on corporate bonds are also going up. So, it's kind of a situation that's why I said there's just so much money going into the various markets. I truly hate the word bubble, but I find myself wanting to say it.
Yeah. Well, here's another interesting one. As you watched J.P. Morgan and Morgan Stanley and Wells Fargo and Goldman Sachs, what was interesting as they made their announcements and statements about where they really started to feel the earnings growth, because they had most of them had blowout earnings, it was the fixed income trading that was their biggest surprise, and that was what really vaulted their earnings, not equity trading or the markets. It was fixed income. So, when you look at what's the soup du jour, what's the popular topic, where's the money at, right now it's clearly in the fixed income markets for these institutions. And again, I think it has to do with you've got these negative yields around the world and people are chasing yield. And of course, that's probably keeping Morgan Stanley and JP Morgan very, very busy. They're probably making some great markets out there. And because people don't understand exactly how bonds trade, they're making probably a killing on those spreads as well.
Yep.
Did you find that shocking at all? Like that they made that much money from bonds?
No, I really don't, because as you've been illustrating, the nature of a bubble is you have to feed that bubble. And these institutions make their money by feeding the bubble. Yeah. So, no, it doesn't surprise me at all. 30 years at an investment bank, you want to be the dealer in a bubble.
Yeah, exactly, and that's why they're doing so well. One last thing, You mentioned something earlier to me today, which made me raise an eyebrow, and for those that watch the show and can see it on the HD, I can raise my eyebrow pretty good, ready? There's a new maturity out there.
Yes. Our Treasury hit us with a surprise announcement, which I think actually is great news.
Okay. Enlighten me why, because I look at it and go, who cares? Big deal.
Right. Well, just for the audience, what the announcement is issuing 20-year maturity Treasury bonds. And that might sound like a big yawn, and maybe for people outside the bond market it is. But right now, if you look at the Treasuries, the mix of Treasuries that our government sells to finance our deficit, we jump from the 10-year Treasury note to the 30-year Treasury bond.
Right.
There's a big gap there in the middle. So the Treasury Department decided to fill that gap by starting to issue now 20-year Treasury bonds. But the ramifications of that are really what's going to be interesting, because we got a lot in your audience, we have a lot of futures traders.
Yeah.
And the 10-year Treasury note futures contract is the most popular contract.
Yep.
Well, now we're talking about adding a 20-year, and I'm sure CME will then come out with a 20-year futures contract that we can start trading.
One more
thing to trade. And that's going to have twice the volatility. Yeah, but look at it from a volatility point of view. That fund's going to have twice the volatility of the 10-year.
Yeah.
So for the active traders, they're going to love having that 20-year. So for your futures people, CME hasn't come out with anything yet, but we're all waiting to see what they come out with in terms of contract specs on that. But we should expect a 20-year futures contract. And the other big opportunity is for the bond issuers.
Right.
Because if I'm jumping too fast, let me know.
No, it's one more thing to sell. You've got a new product.
Yeah, well, because now in today's market, when corporations or municipalities want to issue their bonds, they benchmark it against the same maturity treasury. So that's why you look historically, our corporations and municipalities have always issued 3-year, 5-year, 7-year, 10-year, or 30-year bonds.
Right.
Because that's the maturity treasuries we have to use as a reference point. But now by having a 20-year treasury bond, now corporations can issue 20-year maturity corporate bonds. We'll start having mutual funds and ETFs that are benchmarked against 20 years. So right now you have 10 or 30. So the ramifications are really much more to the asset management industry, pension industry, our people who are looking to fund liabilities or retirements in 20 years. It's not just the Treasury itself that's the big news.
Sure. Well, let the 20-year bond market gold rush begin. Bill, I know you're not teaching classes, but I know you do some Mastermind Clubhouse stuff. What's your schedule looking like? Because I know we've got some viewers who would love to learn more from you.
Thank you. Yeah, it's been a growing audience, and I love doing it with the group. So we do it every Thursday afternoon at 4 o'clock. So if you check your schedules, it's myself and Joanne Farley. I kind of give the macro, what's going on in economic for the week, what's going on with the Fed or Treasury. And then Joanne looks at the charts and gives us supply and demand zones on the products we've been talking about.
Nice.
So it runs at 4 o'clock on Thursdays. That's East Coast time, 1 o'clock Pacific. Okay. Every once in a while we have to jump to a Friday, unfortunately, because of my schedule. But we try for Thursdays at 4.
Awesome. Well, one of these days I'll jump in there. I'm always busy at those times. 1 p.m. is my busy work. But I got to get in there sometime because I love your content, love your market analysis, Bill. So thank you so much for coming on the program today on short notice. I appreciate it. I hope I get to see you much sooner than 1 month from now, but hopefully we'll get you here in the next 30 days. All right, Bill, take care.
We'll talk post-Fed, hopefully.
Sounds good. All right, Bill, take care. That was Bill Addiss on the Trading Academy. Well, we have a lot of bond experts, but Bill's just one of those guys that, he is immersed in that field. He's been there his entire career in the financial markets, worked for some major financial firms. So it's just awesome to have him on the program, giving us some insights. And especially that I did not know that there was a new 20-year product out there. Got to love that. He mentioned he'll be doing Mastermind Clubhouse sessions Thursdays at 4 p.m. Eastern. That's 1 p.m. Pacific time. So for those of you who would like to learn more in your online trading academy, you have access to that. I would encourage you to do so. Bill is phenomenal. We cover things rather lightly here. I know he goes much deeper with a lot of graphics and charts and has a really cool little program that he does in that Mastermind Clubhouse session. So I hope you guys enjoyed that one. All right, I had one question I was promising to get to. That was from Arby. Arby says, guys, please tell me what keeps you what prevents you from getting frustrated? Meaning, how do you see your profit consistency, weekly, monthly, and how do you choose your targets weekly, monthly, or maybe daily? It's about experience and understanding what is potential for you in your account and your level of, your skill set in the financial market. So what keeps you from getting frustrated is just having a goal that is fairly achievable. If your goal is to be making 5% a day, it's not a realistic goal. That's overly aggressive, and you're going to get burned a lot, and it's going to frustrate you. So what do you do to set those targets? Well, again, it all depends on your personal account, right? So take your amount of capital. I would trade with regards to the rules that we teach online Trading Academy, which is obviously trading very small share size until you get it. Once you understand it, that helps develop consistency. And if you are consistent with very small amount of money, I know it's not good for you because you're not making tons, but it starts to help you feel comfortable trading with rules, with a plan, and having tactics. So you start to get bigger and bigger and bigger, and then you start to measure from that point. It's not as easy as just taking a class and saying, okay, I've got a $100,000 account, I should be making $5,000 a month, and that's it. Well, who can make that statement? You have to go back and prove to yourself that you can just trade, period, and understand how these markets work. We all want to be pulling out 10% a day. Come on, wouldn't that be amazing? It's not going to happen if you don't know what you're doing. So the major thing here, RB, about what keeps you from getting frustrated is not setting too lofty of a goal. I actually don't set percentage goals anymore because I was getting frustrated if I wouldn't meet those goals. My goal right now is simply this. I have one very, very basic goal, and that is to beat the S&P 500 every year. Now that sometimes becomes a challenge when you have 20, 30% years. Sometimes you might be exceeding that, or sometimes you might be shy of it. But when the market drops 50% and you made 8%, I think that's a significant beat as well. So I have a little bit different benchmarks or levels there with regards to what I'm looking for and how I play that going forward. But those are my basic things. I look at things on a monthly basis, although I have a lot of rules in place that say if I do X amount of trades losing in a row, then I will generally have to stop. I have to move on and take a break for a period of days. So for me, that's a big one, is making sure that if I have 2 losing days in a row where I've hit my daily stop loss from a short-term trading perspective, I stop trading, period, and I'll take 3 days off. For me, that's just a simple circuit breaker. That is the easiest thing for me to do to not go down that downward spiral where you start to lose a lot of money, which many of you have probably done, and you felt the pain of that downward spiral pulling you even deeper and deeper and deeper. So that's all I have to say on that, RB. It really depends on each individual person. We all have different metrics and targets that we're looking for, but you have to really write your trading plan, have your rules in place, and then say, okay, I've got my book of rules. Let me apply that with just all my strategies, entry, stop loss, price target, how much I'm willing to lose per day, per week, per month, and then apply those rules and do it very small. And then once you get better and more confident, then you can start to raise the share size or the contract size for yourself, and then you'll start to see those gains. But it's about developing consistency and do that with a small account first. All right, I was going to go take a break, but I'm not. I'm going to go over economic calendar. But before I do, again, if you guys would like to know more about anything we talked about in today's show, we talked primarily about bond products. If you'd like to know more about bonds or futures or options or commodities or anything to do with financial markets, you can click that link that's showing up in social media right now. That will tell you more information about where the physical brick and mortar online trading academies are. There are 48 of them right now around the world. Preferably, or hopefully one of those is nearest you. If not, we have free classes, paid classes, community events. We have online classes. We have self-paced content, so you can take it from anywhere you want, even on your cell phone. But you can find out more information by clicking that link that's showing up on your social media. Or if you're on the treadmill at the gym right now listening to on iTunes, we love our podcast fans. Go to the button at the top of the screen at powertradingradio.com. Click that free class button, and that will take you to the same landing page where you can find out more information. Okay, Thursday, January 23rd. Is that really what we got cooking tomorrow? Yeah, 23rd tomorrow. An interesting day. I think that maybe today what we saw was kind of an anticipation of crude oil inventories really showing an increase. We have crude oil inventories coming out tomorrow. You also have unemployment claims, natural gas storage, and CB leading index numbers. For the euro, you're looking at monetary policy statement as well as their main refinance rate. No changes expected there with the main refinance rate. New Zealand, they've got CPI numbers, and then we have flash manufacturing and services PMI for Australia as well as for Japan. Moving on to your earnings calendar, we have one big name down there at the bottom. Probably the biggest name is going to be Intel because it's a member of all 3 indexes, NASDAQ, S&P, and the Dow. You see we have Union Pacific, Intuitive Surgical, VF Corporation, Travelers, Discover Financial, STM Microelectronics, Procter & Gamble, Intel, Comcast, Starbucks, and KMB reporting earnings tomorrow. The popcorn trade of the day, though, is going to be your Intuitive Surgical, ISRG. I really quickly want to bring up that chart here, TJ, just because ISRG is one of those ones that is lofty. And when we tend to get lofty prices, that's when things start to get very, very volatile. So ISRG is the ticker symbol I would like you to bring up for our viewers out at home. And you've got ISRG right now, unless they did some crazy reverse split. Yeah, you're at $600. This is one of those stocks that could move 100 points in 60 seconds. So I'd be very, very careful with this one tomorrow. I'll call that the popcorn trade of the day. So put your feet up on your desk. Watch this one as it goes crazy with the bowl of Orville Redenbacher popcorn and have some fun because it will be nutso. All right, let's get rid of all that and go back to your calendar out there. Our guest for the show for tomorrow, and this is going to be much to the joy of Gayer, who is on Power Trading Radio's YouTube channel. He is going to be happy with this one because he asked me a currency question on Tuesday's show, which I said, I'm going to hold that for Thursday's show with Tim Pessett. Tim Pessett will be our guest. We are going to talk about global currency markets. So if you have ones you want us to analyze, Gayer, do me a favor, and others, send those on in at powertradingradio.com with exactly what questions you want us to answer. We'll dive into all Forex show on tomorrow's show with Tim Pessett. And if you have any questions, send them on in at powertradingradio.com. Click the little thumbs up button there on our YouTube pages if you like today's show. And, of course, send us your questions, and we will see you tomorrow. Take care, everybody.